Hi there. I will be doing this exercise on page 19 of your handout. It's a question on asset disposal, a very important question because the accounting period is ending in the or during or in the middle of the year. And whenever you are doing a topic on asset disposal and the year is ending during the year, not the normal year December, then sometimes it becomes just a tricky question. So hence I decided that I do a video on this exercise. And it says the following information was taken from the books of Dudley Traders. We have two vehicles. Vehicle A that was bought on the 1st of March 1990 for 100,000 rands. And we have vehicle B that was bought on the 1st of July 1990 for 120,000 rands. The depreciation on these two vehicles is calculated at 20% per annum using the fixed installment method, which is the straight line method in other words. The following transactions took place during 1994 financial year. That means all the transactions that are below, they took place during the 1994 accounting period. On the 31st of May 1993, vehicle A was traded in for 75,000 rands on vehicle C at New Look Motors. The cost price of vehicle C is 160,000 rands, and the balance is to be settled by 5 equal installments starting on the 1st of October 1993. So now this means that the installment part means that we have to make payments of the remainder of the balance because we gave motor vehicle A at the value of 75,000 rands, but we received motor vehicle C at the value of 160,000 rands. That means the remainder or the difference between 160,000 rands and 75,000 rands must still be paid. So now that difference is the one that will be paid through 5 equal installments starting on the 1st of October, which also means that if you are doing the statement of financial position, the difference between 160 and 75,000 rands will have to be recorded in your statement of financial position as a current liability. And if you subtract 160 from 75,000 rands, you get 85,000 rands. That means these installments will be made from the 85,000 rands that we owe because 75,000 rands was the value or the worth of motor vehicle A that was given to New Look Motors, and they gave us motor vehicle C that was costing 160,000 rands. Then after we continue to number two says on the 30th of November 1993, the owner took over vehicle B at a book value for private use. Whenever the owner takes anything, inventory or asset from the business for personal use, we know that it is recorded as drawings. So now when I treat this, I will treat it as drawings but not as an asset disposal. Remember, this topic has been brought here because we can also treat it as an asset disposal, but in this scenario I will treat it as drawings. However, you can still treat this as an asset disposal. And we are required to do the ledger accounts for vehicles, ledger account for accumulated depreciation, and ledger account for the asset disposal. So now let me begin with the three ledger accounts that we are required to do in this exercise. Then I start by opening a ledger account for motor vehicles or for vehicles. And vehicles always have an opening balance on the debit side. We write our balance and we check the cost of our vehicles. Remember, opening balance does not include assets that were bought during the year. And we know that motor vehicle C costing 160,000 rands was bought during the year. It means the balance of 160,000 rands or the cost of 160,000 rands for vehicle C must not appear in the opening balance. However, motor vehicle A and motor vehicle B, they were all bought before the end of the previous year. That means they become opening balance in the current year. And if you add the sum of the two, that will give you 220,000 rands, which is the total of the vehicles that were bought before the beginning of the current year. Now we record that as an opening balance, 220,000 rands. And we were told that motor vehicle A was traded in. That means we gave away motor vehicle A at the value of 75,000 rands. As you can see that 75,000 rands sitting there. So now here we have 75,000 rands here for motor vehicle A that was traded in. But we don't record this in the asset account because it is the value the asset was traded in. It will affect only the asset disposal. So now when we record in the ledger account, we have to record motor vehicle A that was traded in, and the contra entry will be asset disposal, and we record the cost of the asset because this is vehicles at cost. All the assets are recorded at cost in the ledger account. So now asset disposal cost of motor vehicle A is 100,000 rands, which come from the information provided in the exercise. Here we do have 100,000 rands, which is the cost of motor vehicle A. Then after we know that motor vehicle B was taken by the owner for personal use. So now vehicle B was taken by the owner at the book value. That means the asset or the vehicle is no longer in the business. And if the asset is no longer in the business, it has to be removed from the books of the business. And for us to remove this in the books of the business, we have to credit 120,000 rands. Why must we credit this? It's because the owner took the vehicle. Therefore now hence the contra entry becomes drawings. Remember, assets increase on the debit side, they decrease on the credit side. So we are separating our assets here whenever we dispose or whenever the owner takes the asset, and here we are increasing our assets whenever we buy the assets. So now second one, there was motor vehicle C that was bought. Therefore now whenever we buy, we increase or we plus in our assets, which is in this case motor vehicle. Therefore now we record the cost of motor vehicle C, and we know that motor vehicle C was costing an amount of 160,000 rands, and it was bought on credit. Then the contra entry will be creditors for an amount of 160,000 rands. Why am I saying this asset was bought on credit? It's because in the information provided, we were told that and the balance to be settled in 5 equal installments starting on the 1st of October 1993. That means we still owe the money, hence we have to make payments on 5 equal installments. So now it means we did not pay for cash. Hence now we debit our creditors in the vehicle ledger account by 160,000 rands. And there was no any other entry that affected our motor vehicle. So now we can balance this ledger account. Draw these two lines always whenever you balance the ledger account. Now we have to add the debit side because debit side is greater and the total of the debit side is 380,000 rands. 380,000 rands. And you have to say 380,000 rands minus 100,000 minus 120,000 rands. That will give us the balance of the motor vehicles that are still left in the business by the end of the year. That will be a balance of 160,000 rands. A balance of 160,000 rands. And this is the balance brought down on the beginning or in the beginning of the year. Then now we are done with the ledger account for motor vehicles. We can do the second ledger account, which is accumulated depreciation. Now please don't forget that the end of the accounting period is 28 February each and every year. and we are doing the books for the year 1994. Take that into consideration. So now we are doing the ledger account for accumulated depreciation for motor vehicles. Then open our ledger account, accumulated depreciation, accumulated depreciation for vehicles. Now this ledger account always has an opening balance on the credit side. It will never be on the debit side. The balance for accumulated depreciation is always on the credit side. Remember, on the credit side of this ledger account is a plus. That means it increases on this side. And on this side, on the debit side, is a minus. That means this ledger account decreases on the debit side. So now remember what we record on the credit side of this ledger account. We record all the depreciation for all the assets that the company still have. So now in this case, we still do have motor vehicle A and B. Therefore, now we have to record the opening balance. Remember, opening balance is on the 1st of March 1993. Now let me just show you that in the exercise. In the exercise, the end of the year is 28 February 1994. So now if this year is ending here, it means it started on the 1st of March 1993. 1st of March 1993. Because one day after the end of the accounting period is the beginning of another accounting period. So now this year started 1st of March 1993 and it ended 28th of February 1994. So now it means if we are looking for the opening balance of the accumulated depreciation, we need all the total depreciations until the 28th of February 1993. 28th of February 1993. We need all the total depreciation for all the assets that were in the business until the end of the year 1993. Then their total depreciation will become an opening balance on the 1st of March 1993. Because when 1993 accounting period ended, then 1994 accounting period started on the 1st of March 1993. So now just take into account another highlight. This is the end of 1993 accounting period, because we know that our accounting period is ending 28 February each and every year. So now 28th of February 1993 was the end of the accounting period 1993. Therefore now the 1st of March was an opening balance for the new accounting period, which is the 1994 reporting period, started on the 1st of March 1993. I'm highlighting this because students get to be confused. So it means we need to calculate all the depreciations for all the assets being motor vehicle A and motor vehicle B until the end of February 1993. Then that becomes the opening balance of March 1993, which is the 1994 accounting period, starting 1st of March, and it will end on the 28th of February 1994. So now we have to check our motor vehicles, if when were the motor vehicles bought or acquired. And we are told that motor vehicle A was bought on the 1st of March 1990. 1st of March 1990. Now we need not to forget that the end of the accounting period is 28th of February each and every year. So now it means the accounting period for 1990 ended on the 28th of February 1990. 28th of February 1990 was the end of the accounting period for 1990. So now on the second day, which is after the end of this accounting period, it was the 1st of March. Just watch that. The 1st of March 1990. It is no longer 1990 accounting period, but it's 1991 accounting period, because the accounting period for the year 1990 ended on the 28th of February 1990. So now one day after is the 1st of March, but the 1st of March for which year of 1990, still 1990. But the 1st of March 1990 is the 1991 accounting period, because 1991 accounting period started on the 1st of March 1990. So now it means the motor vehicle A was bought in the beginning of 1991 accounting period. I hope you are all clear with that. Motor vehicle A was bought in the 1991 accounting period, which started on the 1st of March 1990. So now it means when we calculate the depreciation for motor vehicle A, we start in 1991, 1992, and 1993. Then we stop. Then that becomes opening balance of the accumulated depreciation for motor vehicle A in 1994. So now let me do the calculations. That means my depreciation calculation will start for motor vehicle A. Depreciation for vehicle A, and I have just explained that motor vehicle A was bought in the 1991 accounting period that started 1st of March 1990. So now it means when we calculate depreciation, we calculate it for 1991, not for 1990. So now we say the cost of motor vehicle A was 100,000 rands. There was no residual value, then we just times that by 20%. Therefore, now that will give us an amount of 20,000 rands. And in the year 1992, the depreciation for vehicle A will still remain 20,000 rands because motor vehicle A was still there for the full year. It was not sold. It was there for the full year. Therefore, now it still remains as 20,000 rands depreciation per annum. And in the year 1993, the depreciation for motor vehicle A, it is still 20,000 rands because in 1993 there was no selling of motor vehicle A. Therefore, now the total depreciation or the total accumulated depreciation for motor vehicle A will be 60,000 rands, which is on the 31st of which is on the 28th of February 1993, and this is the closing balance. This is the closing balance of the accumulated depreciation on the 28th of February in the year 1990. This is the closing balance. Then this closing balance becomes an opening balance. This becomes an opening balance of accumulated depreciation for vehicle A. Opening balance when on the 1st of March 1993, and the 1st of March 1993 is the 1994 accounting period that will end 28 February 1994. So now opening balance of the accumulated depreciation for vehicle A will be 60,000 rands, but we need to calculate both vehicle A and vehicle B because we are doing the ledger account for accumulated depreciation for all the vehicles that we have. So now take that 60,000 into account before, so that when we do vehicle B, we take the two and we add and they become opening balance. So now let me just wipe my calculations. Then I will show you the calculations for motor vehicle B and how to account or how to calculate the accumulated depreciation for motor vehicle B. So now I think we are on the same page. I think you understand something from now. Just to repeat what I've said, I think you also got that. Motor vehicle B was bought on the 1st of July 1990. So now if motor vehicle B was bought on the 1st of July 1990, you should definitely now understand that it was not in the accounting period of 1990, because the accounting period of 1990 ended on the 28th of February 1990. 28 February 1990. So now anything or any transaction that occurred or any transaction that took place after this date, it was no longer for this year, because this year ended on the 28th of February 1990. So now anything that took place after this date, it was for the 1991 accounting period. So now hence when we calculate depreciation also for motor vehicle B, we will calculate it for 1991, not for 1990, because 1990 accounting period, as I said, it ended on the 28th of February 1990. So I hope now you are more clear with that. Therefore, now depreciation for motor vehicle B will start in the year 1991, and the cost is 120,000 rands. We termed that by 20% because there's no residual value, and that gave us an amount of 24,000 rands as the depreciation per annum. And in the year 1992, motor vehicle B was still in the business. So now it means the depreciation for this asset was there for the full year, or must be accounted for the full year. And in 1993, the depreciation for motor vehicle B will still be 24,000 rands because the asset was there for the full year. It was not sold in any year. Therefore, now the total accumulated depreciation for motor vehicle B will be the sum of the three amounts, which is 24,000 times by 3. Just 24 times by 3. Therefore, now that will give us 72,000. Oh, sorry. Let me just make a correction here. We have to account for the number of months. Sorry for that. We have to account for the number of months because on this 1st of July, it was not the beginning of the year. So now it means the motor vehicle B was bought a couple of months before the end of the accounting period. It means we have to count and say July, August, September, October, November, December, January, February. It means motor vehicle B was in the business only for 8 months. Therefore, now for the first depreciation of the first year, we have to times that by 8 divided by 12 to get to the depreciation for only 8 months. We term that by 8 over 12, and if you say 24,000 times by 8 and you divide that by 12, you get 16,000 rands. Then after we continue with our workings, 1992, and 1992 will be the full year 24,000 rands, and 1993 will be the full year 24,000 rands of depreciation. And if you add the 3, it will be 16,000 times by 24,000 plus 24,000 rands. That should give us 64,000 rands of the total accumulated depreciation on the 28th of February in the year 1993. And this is the closing balance in the year 1993, which becomes an opening balance again. Closing balance will still become an opening balance on the 1st of March in the year 1993, which is the beginning of 1994 accounting period, starting on the 1st of March 1993. So now previously we calculated total accumulated depreciation for motor vehicle A, and if I still remember, that gave us an amount of 60,000 rands. Vehicle A, that gave us an amount of 60,000 rands. So now if this is 60,000 rands, we just have to add the two to check how much do we have as the total accumulated depreciation on the 1st of March 1993. That will give us 124,000 rands. So now I hope that makes sense as I have just explained it. Let me just keep that picture before I continue. Now, please take into account that this depreciation that we have, or these depreciations that we have calculated, they don't include 1994. So now if 1994 is not yet included, it means we still have to calculate depreciation for the current year for both vehicle A and vehicle B, because we have not yet accounted for that. So now I will do that when we arrive on that stage. So now let us just continue with the ledger account as we're busy. So now that means our opening balance of the accumulated depreciation will be 24,000 rands as I have shown you. Then after, we need to calculate depreciation for the current year. Depreciation for the current year. That means our depreciation must be for vehicle A, vehicle B, and vehicle C where necessary. Therefore, now we have to check if when was vehicle A sold or traded in, when did the owner take vehicle B for personal use, and when did we buy motor vehicle C, so that we take into account the number of months. It means our depreciation will be for 3 assets in this case, in fact, where necessary, because if an asset is sold on the first day of the year, then we will not have to account for the depreciation. So let us check in this case. We said under the transaction that occurred during the year that on the 31st of May 1993, vehicle A was traded in. That means it was when on the 31st of May 1993. That is the concern date. So now it means in March the asset was there. In April the asset was there. And in May the asset was there until the end of May. Why am I highlighting these 3 dates? It's because remember the end of the accounting period is 28 February. So now if the end of the accounting period is February, it means March the asset was still there, 1993. April the asset was still there. May the asset was still there until the end of May. It means motor vehicle A was in the business only for 3 months in the 1994 accounting period that started on the 1st of March 1993. So now this is the 1994 accounting period, not 1993, please. So now it means the depreciation for motor vehicle A is for 1994, which is for only 3 months, not 1993, which is March, April, and May 1993 and 1994 accounting period. So now let us calculate depreciation for motor vehicle A only for the 3 months it was in the business before it was traded in. And if you see now, the second one is motor vehicle C. They told us that after that we receive motor vehicle C because there's no date. That means we gave away motor vehicle A and we receive motor vehicle C. It means the purchase or the receipt of motor vehicle C was the date we gave away motor vehicle A. So now we have to count the number of months from June up to February 1994 when we calculate depreciation for motor vehicle C. So now for motor vehicle B, it was taken by the owner on the 30th of November. It means 1993. It means it was in the business in March, April, May, June, July, August, September, October, November. That means here it will be 9 months. And here it will be 3 months. And motor vehicle C, it will be May, not May because it was the end of May already. So now we don't include May whenever it's at the end. That means motor vehicle C was bought at the end of May. So now we don't include May. We start in June. It will be June, July, August, September, October, November, December, January, February. It will be 9 months. So now we have to account for this for 9 months, starting in June until February 1994. So now we have to calculate all these 3 depreciation for these 3 assets and we record them in the accumulated depreciation ledger account on the credit side. So now let us just calculate those. We can start with motor vehicle B. Motor vehicle B, we start by saying depreciation for the full year of motor vehicle B is an amount of 24,000 rands. We know that for the full year is 24,000 rands. There is per annum and here is per annum for the full year. This is only for 8 months. So now we don't need depreciation for the full year. We only need it for the number of months, which is only 9 months. Then we times that by 9 over 12. And if you say 24,000 times by 9 over 12, 24,000 times by 9 over 12, that will give us 18,000 rands as the depreciation for the current year of motor vehicle B. Therefore, now if we say 64,000 rands, which is the total accumulated depreciation of vehicle B up to the end of 1993, we add depreciation, which is this depreciation for the current year. That should give us the total of the depreciation for motor vehicle B. So now let us just show those calculations for this asset. If you add the two, that will give us an amount of 64,000 plus 18,000. That will give us an amount of 82,000 rands. It means the total accumulated depreciation for motor vehicle B until the 30th of November, because the owner took that at the end of November, until 30th of November is 82,000 rands. So now let us go to motor vehicle A and check how much will be the depreciation for the current year and the total accumulated depreciation for motor vehicle A. So now we have already shown the workings for motor vehicle A, and we have seen that it was a total of 60,000 rands where we made our calculations. So now we only have to account for a depreciation for 3 months of the current year. And we know that the depreciation in the year 1994 will be a full year depreciation times by 3 over 12. Depreciation for the full year is 20,000. We know that it is per annum. We know that it is per annum. And we know that is depreciation for the full year. Then we times that by 3 over 12 months. And that will give us a depreciation of 3 over of 5,000 rands. So now this is the depreciation for the year 1994, and this is the total of all the depreciation for all these years from 1991, 92, 93. Therefore now we just have to add the 1994 depreciation being an amount of 5,000 rands, and that will give us an amount of 65,000 rands. So now this is the depreciation of motor vehicle A up to the date motor vehicle A was traded in for vehicle C. Therefore, now let us do depreciation now for motor vehicle C. Depreciation for motor vehicle C, so that we know that we are done with the depreciation for the current year. Motor vehicle C. So now motor vehicle C, remember the cost of vehicle C is an amount of 160,000 rands, and it was acquired in the 1994 accounting period, that we are aware of it. So now we have motor vehicle C in the year 1994, and the cost of motor vehicle C is 160,000 rands times by 20%. And if we say 160,000 rands times by 20%, that will give us 32,000 rands. Remember, this is depreciation per annum. We need it only for 9 months. Therefore, now we say times by 9 over 12 months, so that we get depreciation only for 9 months, and that gave us 24,000 rands. Therefore, now we have to add 5,000 for motor vehicle A, and we add 18,000 for motor vehicle B. I think you still remember these amounts. Depreciation for the current year for A was 5,000, for B it was 18,000 rands. We plus 5,000 and plus 18,000 rands, that will give us an amount of 47,000 rands, which is the total of all these three depreciation for the current year. Now the question is, must we add all of them and we record them in one as one amount? The answer is definitely no, because these assets, when sold, one was sold on a different date, another one was taken by the owner on a different date. Another one was in the business until the end of the year. So now we only have to record them separately. And we start by the depreciation for motor vehicle A. And depreciation for motor vehicle A is an amount of 5,000 rands. And we record 5,000 rands. And depreciation for motor vehicle B is 18,000 rands. And depreciation for motor vehicle C is motor vehicle C, let us check, is 24,000 rands. So now we record that as 24,000 rands. So now we have all the depreciation separately. Let me repeat again. This depreciation is for vehicle A, and it was recorded when vehicle A was traded in, which is 31st of May. And this is vehicle B. Vehicle B was taken by the owner at the end of November. So now when the owner took that, it was immediately recorded as a depreciation up to November. And vehicle C was in the business until the end of the year. So now its depreciation will be recorded at the end of the year. So now these are different dates. Hence, we must not add all the three and have one sum of the three amounts. We don't do that when transactions occurred on different dates. So now we have to record the accumulated depreciations now, or remove the accumulated depreciation for the assets that are no longer in the business. Remember, motor vehicle A is no longer in the business, motor vehicle B is no longer in the business. So now we need to remove all their accumulated depreciation. And for us to remove that, we have to record it on the debit side of this ledger account. Therefore, now we will have the contra entry as asset disposal. Remember, motor vehicle A was traded in. So now that is taken as an asset disposal, because a loss or a profit can be made on the disposal of an asset. Therefore, now we have to check how much was the total accumulated depreciation for motor vehicle A until the end of the year. Let us check in our background information. Vehicle A, we don't have it there. Vehicle A, we calculated that, okay, it gave us an amount of 65,000 rands. If you still see that, there is 65,000 rands, this one. Total, we added the 60,000 for 3 years, 91, 92, 93, and we added depreciation for the current year only for 3 months, 5,000. Therefore, now we are recording 65,000 rands of the total accumulated depreciation for motor vehicle A. So now let us record that immediately. Therefore, now we debit that as 65,000 rands. Remember, 60,000 is already inside here. Don't forget, 60,000 we have proven that is in the opening balance, and 5,000 is here. So now if there's 60,000 there and 5,000 here, we have all the rights to record 65,000 rands, because we are removing it from these two amounts on the credit side to the debit side. So now we have to record again the accumulated depreciation of motor vehicle B, because the motor vehicle B was taken by the owner, and we said that it will be transferred into the drawings account immediately. I know in the memorandum it says asset disposal. That is another approach. It is also correct, but this is another approach that you can use this, because the net at the end is the same. However, I'll explain it in class how are the two the same. So we have to record 82,000 rands. I think it was 82,000 rands of the accumulated depreciation for this motor vehicle. Let us just confirm. Motor vehicle B, we calculated the depreciation for motor vehicle B. There we have it. We have 82,000 rands, which was the total of all the accumulated depreciation. It was 64,000 rands for the past 3 years, 64,000 rands, which was for these past 3 years from 1991 until 1993. And in 1994, we calculated depreciation only for 9 months, and that became 18,000. And we added the two, and that gave us 82,000 rands. So now we know that 64,000 rands is in the opening balance already, which is here in this 124,000 rands. This 64,000 rands is already there in that opening balance. So now 18,000 is recorded. You have seen that. Therefore, now we can remove the full 82,000 rands on the debit side of the accumulated depreciation ledger account. Hence, we have that 82,000 rands sitting there. Therefore, now we can balance this ledger account, and the bigger side is the credit side, and the total is 171,000 rands, and the total is 171,000 rands. If you strike the balance, that will give you the balance carried down of an amount of 24,000 rands. Why is it so small? Because this is the accumulated depreciation for motor vehicle C only. As you can see, is that one. Why must it be only that amount? Because the accumulated depreciation for vehicle A and B is no longer in the business. So now that is why the closing balance becomes only the depreciation for the asset that is still left, because we don't need the balance of the depreciations for the asset that are no longer in the business. Therefore, now it's balance carried down, and it becomes balance brought down 24,000 rands on the credit side. Then that will be balance brought down on the credit side. So now I hope that is very clear. So remember, now we had drawings there, not asset disposal, and we also had drawings here, not asset disposal, as the contra entry. It means these amounts will not go to the asset disposal ledger account in the viewpoint in which I am doing this exercise. As I said, that you can do it in the viewpoint where you transfer this to asset disposal and you transfer this to asset disposal. You will still be correct unless you are instructed to record it in the asset disposal. Then you have no choice. However, there is an option to record this in the drawings, because it's drawings, the owner who took the asset for personal use. Then after we do the last ledger account, asset disposal, and if it's asset disposal, we know that on the debit side we record the cost of the asset that was disposed, and the cost of the asset that was disposed is vehicle A, and vehicle A costed the business 100,000 rands. We remove the cost. Remember, this is the double entry rule. For every debit, there is a credit. Asset disposal is credited in the ledger account for motor vehicle. That means asset disposal must be debited by motor vehicle in its own ledger account. Then after, we also know that under the accumulated depreciation, there was the total accumulated depreciation that was removed on the debit side, because that asset was traded in, or it was given away in terms as trade in, and that asset was motor vehicle A. So now it means the 65,000 rands that was removed and the contra entry was asset disposal must come to the credit side, so that the double entry rule applies 65,000 rands, and the contra entry will be accumulated depreciation. Apologies for the shortcuts. So now we gave away, remember, we gave away motor vehicle A to receive motor vehicle C, and the value of motor vehicle A that we gave away was 75,000 rands. So now you always write that, which is the amount by which the asset was given away, or the amount by which the asset was sold. You always write that on the credit side. If the asset was sold for cash, then it will be bank. If it was sold on credit, therefore now that will be debtors. So now we say it was given away to our creditors, and we still owe them some money, therefore now contra entry will be creditor. Then after, we have to check if have we made a profit or a loss on the disposal of this asset. Let us check. Have we made a profit or a loss on the disposal of this asset? How do we check that? We need to know the carrying amount, and we need to know the cost price, and we need to know the accumulated depreciation. That means we have to say cost minus accumulated depreciation. That will give us the carrying amount or carrying value. So now let us calculate the carrying amount for motor vehicle A. We know that motor vehicle A has a cost of 100,000 rands, So now, if it has a cost of 100,000 rands, we have to subtract the accumulated depreciation. We are calculating carrying amount. Carrying amount for motor vehicle A. Carrying amount for motor vehicle A. Carrying amount for vehicle A. Remember, carrying amount is normally abbreviated as CA. So now we say carrying amount is equal to cost minus accumulated depreciation. And our carrying amount is, our cost is 100,000 rands. Our accumulated depreciation for motor vehicle A is definitely there in the ledger account. Accumulated depreciation is 65,000 rands because this is motor vehicle B. It is 65,000 rands. So now if we say 100,000 minus 65, that will give us 35,000 rands. That means 35,000 rands is the value or is the worth of the asset in the books of the business. So now if this is the value of this motor vehicle, which is vehicle A, in the books of the business, so we expect that it must be sold at that price. But if we sell it or if we trade with it at a price higher than what it is worth, then we make a profit. And if you remember, this asset was traded in for an amount of 75,000 rands. That means we traded with this vehicle at a higher price. Therefore, now the difference will definitely be a profit. This is a trade in value. The amount we traded in or the value we traded in the asset with trading. And if you say 75,000 rands minus 35,000 rands, that gives us an amount of 40,000 rands. That means we made a profit on the disposal of, or profit on trading. Profit on trading, which we normally call it profit on the disposal. So now we made a profit. And if we've made a profit, we have to recognize that as a profit on the debit side of our asset account. So our asset disposal account. Then after we record that on the debit side as 40,000 rands profit on the disposal of the asset. Then now make sure that your debit is equal to your credit. If that is not the case, then something is wrong. Your debit must be equal to your credit. Therefore, now it means this will be 140,000 rands. We add 65,000 rands plus 75,000 rands. This also gives us 140,000 rands. In other words, other ways, as I always highlight it, you can take the bigger side or fish the big before you take the profit. You can take the bigger side and say 65 plus 75 is 140. 140 plus 100,000 will give you a profit of 40,000. If the difference falls on the debit side, then you get a profit, and if the difference falls on the credit side, after you have recorded everything, then that will be a loss. So now on my side, I will say thank you, all the best. I am done with this exercise. I'll try to do as many exercises as I can. Thank you. Hope you have learned something.